All right, Ken Orange Theory Trader back with you with another video on the truth about making big gains in forex. Let's not waste time and get right into it. The key to making big gains in a smart way is the quarters theory. I take no credit for this idea. I got it from a gentleman by the name of Mark Minervi. I'm hoping to say his name right, but he's a stock trader. I'm a forex trader, so I wanted to personalize this model to my fellow forex traders out there. So the math is still the same. All right. The quarters theory is just a way to manage your risk. So you take your total risk, whatever it may be, and you just divide it by 4. There's a simple example here. Let's say you got to give it any given trade. You know, okay, the most I want to lose on a trade is 20 bucks, right? If you take 20 and divide it by 4, that gives you 5. Okay, quarters, 25, 25, 25, 25 gives you 100. Okay, so that's 4 entries worth $5 of loss. Okay, so you're just going to divide your risk among 4 different trades. Okay, but the key is that you only add the following positions after your first trade shows a profit. Okay, you don't just, well, I'll show you this. Okay, so here's how many traders are taught versus using the quarters theory. So on the left hand side, we see if you just have regular 1 to 3 risk to reward ratio, same max risk. Let's say you want to risk 20 bucks. Okay, you risk 20 bucks to try to make 60, 1 to 3. All right, your worst case scenario from the jump is 20 bucks if that trade goes against you, if you just let it play out. Your best case, $60 or so, $60 if it hits the TP or take profit. But the thing is, why would you go all in on the first hint of a possible trade? Okay, don't be desperate, because remember, you're not going to win every single trade. It's like if you're looking for somebody to marry, you don't marry somebody after the first date. Okay, your first entry is like the first date. You have to decide whether or not you like that trade. Just like you have to decide whether or not you like that person. Okay, don't be so quick to commit is the point. Okay, to use an analogy. Now with the quarters theory, what you're going to do is remember your risk, and it's already divided by 5. All right, so the quarter theory says that you have $5 worth of risk, and for every position that you take, that's $15 worth of reward. Okay, it's still the same 1 to 3. But here's where things get interesting. If you take that first trade, and let's say it goes against you immediately and continues up, or whatever way, continues against whatever position you take, and it stops you out. You didn't lose 20 bucks like you did on the left. You only lost 5, because let's just say that first trade never showed a profit. You were just wrong for that time frame. Okay, which sounds better to you, losing 20 bucks once or losing 5 bucks? Okay, on a trade. All right. So your worst case could still be $20 if the trade does retrace against you. However, once you take the first trade and it shows a profit, then you add the next one, you see a little more profit, then you add the next one, then you add the next one. Now, will the price differential be, will the entries be different? Yes, they will. Are there times where trades pairs may move too fast and you may not get the best entries on the subsequent entries? Yes, but at the end of the day, if you get the direction right, you're going to make money. Okay, you're going to make money. So the thing is, your worst case scenario could still be 20 bucks or as low as 5, and your best case scenario could be 60 or more, because you've taken multiple entries. And sometimes it may go for 1 to 4 or even 1 to 5. The downside though can be much lower if the trade goes against you, and it gives you more chances to get the trade right. So just say, for instance, you go in on a trade, you lose, okay, it's 5 bucks. You go in again, you lose, lose 5 bucks. You go in again, and this time it hits, and you put all 4 quarters in. All right, you lost $15 on the first 3 trades, but on the last one you make 60. You still end the day net positive when all the math works out. Okay, so get to know the trade before you commit to it. So what we're going to do for the duration of this presentation is go over 3 models: a low risk model using the quarters theory, a moderate risk model, and a high risk model. So these are the numbers for the sake of this presentation. We have a low risk model with an account balance of say 200 bucks, moderate and high risk. So let's say for the very low risk bottom of the barrel, we're only going to lose 2% of our account. That's our max risk. 2% of $200 is 4 bucks. So your risk to reward in that case, where you're going to risk 4 bucks to try to get 12 bucks when it's all said and done. That's worst case scenario. Okay. That's 4 $1 entries. Okay. I hope that makes sense. So you're not risking $4 on the first go round. You're risking $1 on the first one, $1 on the second one, and so on and so forth. Okay. For the moderate risk, your worst case scenario is going to be 10 bucks. That's your max risk. That's 5% of your total account, which is a big number. Let's not act like it isn't, because it is. Okay, but that's 4 entries worth 250. All right, so 1 to 3 is 10 to 30. All right, 10 bucks you're risking 10 bucks to get 30 bucks. Then the last one, which is high risk, You're going to use 10% as your worst case scenario. That's going to be 4 entries worth $5 each. You're going to risk $20 to get $60. All right, so there you go. So for this simulation, we're going to go to 1 to 3 risk to reward ratio. And all of these charts I'm going to show you assume a 40% win rate. So this is the low risk model and a $200 account. Now you can pause to really look at this. You're going to see the wins and loss here when it's going to be based on percentages and not dollar amounts. So just for instance, you lose 2% here, 2% here, but you win 12.74% here. All right. Oh, and I'm sorry. I apologize. These are it's missing the dollar sign. I apologize. You lost $2 here, $1.98 here, but you won about $13 here. Okay, so this is the money. I'm sorry. This is the percent change over here. So you lose 1%, 1%, you gain 6.5, et cetera, et cetera. Okay, so again, you can pause to look at this if you want to really look at the numbers. But the final analogy is that, or the final result is that based on a $200 account using low risk, okay, with a 40% win rate, 1 to 3 risk to reward, you still grew your account by 21%. All right. And the AI, I use grok.ai to crunch these numbers. You can do the same. Okay. But this is steady growth with minimal drawdowns. Okay. Now let's take a look at the moderate risk. So remember now, first couple of losses, you lose $5, a couple times, but then you win 33. Okay. And so on and so forth. You can pause to read it if you like. But obviously the wins are much bigger than the losses. Okay. So you have, you lose a couple percent here, percent here. Now just keep in mind too, these are just ballpark numbers. Your account will not look exactly like this. Okay. It just won't. All right. But this just gives you a framework to know, okay, my losses should be around this range and my wins should be around this range. Okay. So on that one, you got almost a 64% gain using a moderate risk on a $200 account, but you are going to see more volatility in your account, but the upside takes care of the downside, so you don't have to worry about that. Lastly, we had the high risk numbers. So obviously here the numbers are going to be a little bigger because the biggest loss here, I believe, was $18. The smallest loss, or the biggest gain rather, was I think $111 here, so that was pretty good. Okay, 32% gain on that one. That was really good. So for this one, you took a $200 account up to $453 based on using the high risk method with a 40% win rate. You did have some significant drawdowns because you did get some trades that were close to the max 10% loss per trade. And remember, 10% of 200 is going to be $20. So the big picture, because we're always thinking long term, I wanted to crunch the numbers on a $10,000 account. And for these next two illustrations, I got rid of the high risk model because you really don't need high risk once your account is big enough. Okay, you really don't. So this is the low risk model with $10,000. Obviously, with 1% of 10,000 is going to be $100 on that loss there. But you see the wins here: 637, 665, 701. So you can pause to look at that if you like. These are the percentage changes on the account. Lose 1%, get almost 7%, etc., etc. And the account ends in $12,000. So you made a couple grand on that, which is good, with 4 wins and 6 losses. And this is the moderate risk level. So you can see the percentages here for the losses and the amount gained. 1,600 there, 1,800 there, 2,500 there. And using the moderate risk, you made about 6 grand, 64 grand almost. 6,400. I'm sorry, not 64,000. You made about $6,400 on a $10,000 account using the moderate risk model. Okay, so that's that. So I did ask the AI to give me some modifications to the plan to make it, to increase our odds of success. The main one I only wanted to point out was that avoid trading correlated pairs, meaning that sometimes two pairs move the exact same, so you don't want to trade both of them at the same time. Okay, so the ones that move the same, not always, but enough for you to be aware of it, is these have an inverse correlation. The dollar, euro dollar, and dollar Swiss, they're inversely correlated. So if you got a position on dollar, euro dollar, you really don't need to trade dollar Swiss because they're just moving opposite of each other for the most part. If you're taking euro dollar, you really don't need to trade pound dollar because they tend to move in the same direction. Not always, but enough to say you don't need, for enough to make you think that you don't need to trade both. Aussie dollar and US dollar, same thing. They tend to move in the same direction. Dollar yen and Aussie dollar tend to move opposite of each other. So keep that in mind. And as well, euro dollar and Aussie dollar, they do tend to move in the same direction. So only trading one of those would be fine. My own personal observation, I say that the higher your balance, the lower your risk should be. So if you're starting with a low balance, if you can afford to lose, start with the high risk model, but always have the goal to graduate to the low risk model. Okay, because the low risk plan had a 21% gain. Let's not forget that. Let's go back to that just so I can remind you of it. This low risk still got you 21%. Okay, it's right there. Ballpark, okay, ballpark. Okay, using the quarters theory by scaling in or adding to the position, or pyramiding, as it's also called. But remember that 21% of 10,000 is $2,100. That's not bad. It's really not. Okay, if you're already working a job and you can make an extra $2,000, who's complaining? All right. So remember, the high risk model is really just to get your, get you going, but it's not meant for you to stay on it. So feel free to design your own theory. This is the quarters theory, but you could just as easily have a 1/3, 1/5, 1/2, where you say if you want to risk $20 on an account or on a trade, you risk $10 on the first entry. If you like it, then risk $10 on the next one, and then that's it. Or you can divide it by 3. So if you had, let's say, 15 max loss, $15 max loss, you take $5 on the first one, it goes into profit. $5 on the next one, and then $5 on the last one. 5 is 15. Okay. So, you do what fits you. This is just a general framework to get your wheels to turning and try to calculate, okay, if I want to make more money when I'm right on these trades, then how can I do so? So step number 1 in that, though, is you have to know your max risk. What's the most you're willing to lose on any one trade idea, and then go from there. So I appreciate your time and attention. Be sure to check the links in the description for more training, and I hope you have a great rest of your day. Take care.